Welcome to the Finance Village podcast, where we navigate the dynamic relationship between financial professionals, their industry, and the clients they serve in an ever-changing landscape. Let's begin. Hi, everyone. Welcome to another episode of Finance Village. Today, we're going to be talking about what's going on in the S&P 500. There's a lot of changes, a lot of decline, and we're going to be talking about how this affects financial advisors, how they manage it, and how you should be managing it as a consumer and investor. We've got my co-host, Sean Adeyemi, and today we have a special cameo from Zael Miransky. I hope we said that correctly. Zael is a president at MCO Private Wealth. Great financial planner. If you're looking to follow some spicy content on LinkedIn, it's always extra spicy crispy on there. And we're going to be talking about the S&P drama today. So we'll get over to you, Zael. We often will hear that, market volatility is normal. The fluctuations are a regular part of investing. It dropped and then, it bounced back. A lot of people will say it can be attributed to noise in the market. Give us an idea to help dissuade some of the million phone calls that'll happen. Should we freak out and be pulling our hair out and running the streets naked?
Well, first, absolutely don't cause any bodily harm, no pulling out hair, no injuries of any sort. I don't think that it's really necessary. And assuming that we can discuss the day this is being recorded, which is now August the 6th, if we had, panicked and sold everything yesterday, right now at 12 o'clock Eastern time, the S&P is up about 2%. So it really goes to show that it's not so much how much money you have invested or whether or not you think you are smarter than the markets. If you have a long-term time horizon and you can zoom out and take a long-term approach, the 5-year return on the S&P has still been 75+%. And if you're going to look at intraday trading as any indication of long-term success, I'd argue that it's already very contradictory in and of itself. So make sure you do have a long time horizon for markets that have volatility and standard deviations of 15+%. But anybody panicking for a 1-day return or even a 1-week return, if their horizon is 100 years in some cases for children or 50 years for your average 30-year-old, there's zero reason to be panicked as long as you understand deviation and as long as you understand the opportunities that lie inside of markets and their efficiencies.
I think I would say, one, the world is a global village. And so I know there's a lot of noise going around worldwide on different sectors. There's the oil sector, there's the BRICS nations and the movements, there's the US dollar, there's what's going on in Japan with their currency and the economy. So the myriad of factors going on, which kind of attributes to the noise. Now, it doesn't mean that any of that noise is invalid. In some cases, they are valid. But like Zael said earlier, in the short term, if you're watching that volatility and making decisions based on that, then you're making a big mistake. Because when we look at historically, if you are invested for the long term, a lot of this noises will correct itself. And even some of the inefficiencies in the market, as the changes happen, will correct themselves over time. It's very easy to just zoom in and look at everything and say, oh, wow, the sky is falling. I got to do all of that. And I would highly recommend not to do that.
I'm going to give you a personal example because I think it's very real to a lot of individuals. I have a baby at home. He's 11 weeks old on Friday. If I just took his crying to mean that he wasn't all right and I need to do something in panic, it would completely discount the fact that like every single human being, particularly babies and children, they make noise, and sometimes noise gets attention. Most of the time, if you ignore the noise, that child or that baby will stop crying and everything will go back to normal. So this is my real life example in seeing a young mind grow. He's going to cry for 10 minutes. And the markets, just like anything, are still, in my opinion, sort of, a living, breathing entity, despite the fact that they're made up of corporations. Corporations are ultimately made up of human beings. So you can't really just focus on the short-term noise. I think Sean made a great point when he referred to the Japanese economy. Obviously, the first time in a very long time, we saw them have positive interest rates. And even if that's 0.25%, there were many people borrowing money in Japanese currency, exchanging it into US currency, and finally then using that US currency to borrow against US or other economies that are paying a couple percent. So Sean made a great point when he said the world very much is interconnected. It is a global economy, a global village. You have to realize that noise is going to come from somewhere and that sound waves travel. It's not going to directly impact you unless you let it. So really kind of tune out that noise.
And one thing I'll highlight, and I always like to highlight it on the savings side, because again, this is something that people don't think about enough. We say, okay, let's not go out for this fancy dinner tonight. We'll save ourselves $100. We'll be financially wise. But if you don't transfer that money into a savings or purposefully allocate it towards something, then you're not realizing the savings. In the same way, if you don't freak out and sell it all off, you're not realizing the loss.
Because it's at the moment it's paper loss, and it's not a realized loss until you actually sell those positions and make those changes.
As a layman, as a fisherman's son, I always hear that these are sometimes for the fancy pants investors an opportunity for buying, not necessarily something you probably always want to do in a leveraged position. Leveraged meaning you're borrowing against maybe a home or an insurance policy or some type of leverage loan to invest. But if you've got the casino money and you want to do a little of gambling, then it could be a buying opportunity. I'm going to say that as a layman. I want you guys to speak to that real quick. Again, we're not giving advice that people should go run and buy it, but that is something that happens, right?
Yeah,
Zael?
I don't think it's a run and buy opportunity, but what certainly is a rebalancing opportunity. And I think so many investors, and it's unfortunate when certified financial planners like Sean and myself, if you overextend yourself with the number of clients that you actually have, you miss opportunities to service your clients. And for me, what
Absolutely.
the current environment really speaks to is an opportunity to ensure the S&P is still up 10 plus percent on the years. If you are only focused on 1% or a 2% loss or a 3% loss, and you actually haven't done anything in terms of rebalancing your portfolio, perhaps what you actually are is overexposed on a risk tolerance perspective. If you started the year with a 50% S&P exposure and a 50% cash exposure, as a very simplified example, at this point last week, you would have been something like 60-40. And I would ask any client that I have is, if you were 50-50 at the start of the year, how did you just become 10% more risk exposed because your portfolio did well? They're the same risk tolerance where they were at the beginning of the year. They didn't get riskier because they made money. They made money because their original allocation performed well. So it's a great opportunity just to address risk and suggest to somebody, well, if you lose 20% today, 20% of 50 is not the same thing as 20% of 60. So where is that comfortable area to be invested in? From a really very broad perspective and not actually being invested in any specific index, this is a risk question. And if you are prepared to make the money, you have to be prepared to lose the money. And I think too many investors lose sight of what does go up will go down, and over and over and over again. You don't go on a roller coaster just to go up perpetually, up forever. The enjoyment of it is actually in the exhilaration of being on a roller coaster is going down as fast as you go up. So maybe you belong on the kiddie ride and not the roller coaster if you can't deal with the standard deviation, but take that deep introspection and say, well, what can I actually do to mitigate risk when I have made money? And it's not selling everything. Perhaps it's selling some of the gains and reinvesting back into what was a more appropriate risk tolerance. Or on the flip side, when you are down money, you don't become more conservative. Take some of that cash and rebalance to where you are a comfortable investor.
I'm going to close out by just highlighting, and I got this information from the internet, and we all know the internet can be interesting, but when we all know that during COVID, the markets kind of, got a little funky and took a big dip. But since that, the market correction in 2022, and they've performed up until now, the Dow Jones at over 48%, S&P at over 80%, NASDAQ at over 105%, Russell 2000 at over 35%, Toronto Stock Exchange over 34%. So historical data suggests that staying invested rather than panicking during market declines typically rewards investors over time. Professional advice can help investors navigate volatility and kind of align those things that they're feeling with their financial goals.
To what you know how to do, and I know he knows how to stay true. You can see it in the background, so that's pretty much it. And throw a hat on for a rainy day.
Stay vanilla. That's all I can add to that. Stay vanilla, stay basic, do what's been working, and don't try to swing for the fences and make few changes.
And really appreciate you jumping in with us, even from the cottage today, Zael.
My pleasure, and absolute pleasure to be on here with the two of you.
Thanks again. We'll catch you on the next episode. Have a great day.